Earnings season has just kicked off and 5 major stocks are going to drop their reports before the end of the month. The big question that a lot of investors always have is, do I buy now and hope for a breakout, or do I wait? Now, before you get too excited, let's clear something up. Earnings reports can feel like a jackpot moment. You've heard the hype. You might have seen a stock like Meta jump 30% after hours. Suddenly you're thinking, should I buy the next stock reporting earnings and cash in before it pops? But remember, for every Meta, there's a Netflix, which goes down 20% in a single day a couple years back. This is exactly why you don't treat the stock market like a casino, like a lottery. When you buy a stock, you're not betting on some ticker going up and down, flashing green, flashing red. You are buying a piece of a business. In this video, I'm going to show you 5 of the most anticipated companies that are reporting earnings before the month ends. And most importantly, I will show you the difference between price and value, how to find the value of those companies, and the price I would potentially pay for each one. If this is the first time you've watched our channel, this is going to be something you're going to hear till you're blue in the face. Price versus value. That is your goal as an investor, to buy when price is below value. Stock number 1, UnitedHealth, UNH. Okay, guys, you've probably seen these headlines. The stock dropped hard this year. People panicked. But let's slow it down and walk through what exactly happened. First, medical costs came in much higher than expected. That hit the company extremely hard, especially in their Medicare Advantage plans. More people needed care, and that cut into profits. Then came the Q1 earnings report, and it was awful. They missed expectations by a wide margin, and that always shakes markets. Why is that? Well, because they have up until they report earnings to sit there and kind of warn people what's going to happen. So when they come up to earnings and they miss by a big margin, it means they were probably afraid to really let people know what was going to happen. And if that wasn't enough, their CEO suddenly resigned in May. That alone would make any investor uneasy. Top it off, the Department of Justice opened an investigation into the company. The combination of all of this created the perfect storm. The stock dropped, fear took over. But here's the thing. UnitedHealth is still the leader in healthcare. It still dominates Medicare Advantage. This wasn't a total collapse, but it was a tough stretch. Now, there is a new leadership team. They're focused on becoming far more efficient, and they're even exploring, ready for this, the use of AI to improve operations. Can you believe it that somebody is using the word AI, artificial intelligence, in order to get people's attention? But more importantly than the words AI, the letters AI, there is 2 letters that I want you to remember. WB, Warren Buffett. He bought 5 million shares of UnitedHealth last quarter. That's around $1.6 billion. Guys, Buffett doesn't chase hype. He buys value when others are scared. He's not trying to guess the bottom. He's just trying to buy great businesses at a price that makes sense. He understands insurance. He understands how to value an insurance business. And as he always says, be greedy when others are fearful. And right now, people appear to be very fearful about UnitedHealth. Now, the good news is, analysts still believe that this company has a strong long-term potential. Now, don't be afraid of the fact that 55% of their business is Medicare. And if this Department of Justice investigation potential is to shut down their Medicare division, is that likely? For a company that does the revenue they do, probably not very likely. But the average analyst forecast shows over 20% upside from here. They expect earnings to rebound, and they expect the company to get far more efficient. They believe that this business is still positioned to grow as healthcare demands continue to rise. Why is healthcare demand continue to rise? Guys, 60, 70 years ago, you were lucky to make it to 65 or 70 years old. Now, they're saying that in your average kindergarten class, there's at least one kid who will definitely see over 100 years old. For the record, I believe that's a low number. I think it'll be much higher than that. As people get older, they're gonna have more issues with all these diseases. So this is something that healthcare needs to get a tackle on. This isn't some high-flying speculative tech stock. This is a real company with real cash flow, real customers, and a long-term runway. And the great thing about healthcare businesses is they don't make bets on the long run. Every year, they're charging new premiums. So they have to worry about how are things changing over the next year. It's not like a life insurance business where they have to sit there and say, okay, Somebody's buying a 50-year life insurance policy, a 30-year life insurance policy, but how will medicine change in the next 30 or 40 years? This company is insuring people for next month, next quarter, and sometime in the next 12 months. Now, guys, I want everybody to understand this. I believe in having a circle of competence. I don't understand insurance companies. Warren Buffett understands insurance companies. Could you try to clone him by buying this company along with them? Yeah, maybe so. I don't know if that's the right idea or not. All I know is insurance companies make money in a totally different way than what's up here. But I wanted to talk about this company because it is on everybody's mind. I mean, look, we have over 100 community members who've even voted on it and rated a buy. They probably know insurance companies better than I do. I'm okay with that. I stay within what I know. Insurance companies and banks, I don't know how they make money, so I don't know how they're going to lose money. That's the mentality I want you to have. It's okay to say, I don't know. But if you're interested in UNH, either find somebody who understands insurance companies, or you should go learn about them. And a great place is our community. There's thousands of people in that community, and many of them know a lot more about certain areas of the market than I do. And I highly, highly encourage you, especially our guy Dalton. He understands insurance companies far better than I do. Now, no matter what you decide to do, something that I've noticed in my 30 years of investing, most investors are going to lose money because they're trying to pick massive winners. Think about that for a second. It sounds counterintuitive. Well, don't we want to pick big winners? Well, the best investors don't do that. They eliminate the losers first. That's what we're trying to do here on this channel. When we analyze a stock, we're trying to find the obvious reasons to avoid it. Because remember, there's always reasons to avoid every company. But just because there's a data point doesn't mean it's a very important data point. We are here to teach a process that allows you to look at these companies that you understand and go further in them. Stock number 2 is Meta. This is a company I do understand how they make money and how they can lose money. And this is a company that I was buying all the way down as it fell to $88 per share. This company owns Facebook, Instagram, WhatsApp. Over 3.5 billion people around the world use their products every given day. But today, it's not just a social media company. It's becoming an artificial intelligence, AI-powered advertising machine. Now, before we get into that hype or the risk, let me make one thing clear. Meta is a real business. It has real profits, it has real users, and it has an incredibly strong balance sheet. Those are 3 things that I sit there and cannot ignore. That allows me to go, okay, that's probably not going to be a loser of a company. It's hard for a company with very little debt, growing profits, and real users to go under. But what gets people excited is what's going to happen next. Meta is pouring billions into AI, especially to make advertising smarter. There's that video out there where Trump asks Zuckerberg, hey, how much do you expect to spend in the next 5 or 6 years on capital improvements and CapEx? He said about $600 billion. And guess what, guys? Everything they're doing with AI is already working. Advertisers are getting better results. That means more money for Meta. And it's why analysts say the stock could go much higher. They're also investing big into Facebook Reels, their short video feature on Facebook and Instagram. It's competing directly with TikTok. Better recommendations, more engagement, and now features are keeping people watching longer. Guys, more attention equals more ads. More ads leads to more revenue. Now, right now, analysts give Meta a strong buy rating. But remember, why is that? Well, a big reason for it is analysts are lemmings. And the stock is at $730 per share and has gone straight up since November of 22. But this is exactly where we go to slow down. Meta is a stock with real growth potential, but you have to understand what you're buying. This isn't about gambling on the next trend. It's about owning a business that might keep dominating, but only if it makes the right moves. Meta has cash, they have scale, and they have a plan. If you're buying a Meta today, you're betting on their ability to turn huge investments into even bigger profits, which very well could make sense. But if your sole reason is, hey, they're making big investments, it's going to lead to bigger profits, that's still true if the stock price is $7,300. If the stock price is $73,000. This is an exercise I tell people to do all the time. If your thesis on a company doesn't change as you add zeros to the stock price, then you're not factoring in price versus value. You're not investing. You're only buying into a story. But in value investing, we care about one thing above all, the difference between price and value. Because we don't just buy stories, we buy businesses. So let's take a look at Meta's numbers here, these metrics that we want to focus on. It's a $1.9 trillion business with an enterprise value of about the same. What this means is the difference between market cap and enterprise value is essentially how much debt they have on hand, okay? This debt on hand is about $100 billion, not even, $50 billion in some regards. Guys, they generated $50 billion in cash flow last year. So essentially their net debt can be wiped away with just 1 year of cash flow. And the best part is their cash flow in the last 5 years has been $38 billion a year. Last year was $50 billion. That means they're uptrend here. Now, what I love is in our community, we have an average rating of a hold and an average intrinsic value of $656 for the stock. This is what's incredible about our community. They see a company that is skyrocketing and they say, wait a second, this is a great business, but maybe it's getting a little too pricey. In fact, 4.5% think it's a strong sell. That's what's interesting. All right, we have a price to free cash flow of 37 and a PE of 26. Why does that bother me? Well, because their net income is 71 billion, their free cash flow is 50. Now, for those of you who are new, there's a lot of numbers coming out here and it sounds overwhelming. Trust me when I say we have all been there. I'm going to try to break this down as easily as possible. That way you can understand it. But even better, I've created a cheat sheet so you can get all of these metrics sent to you and explained to you in a very easy PDF. That way, when you log in, you can see this, understand the numbers, and understand what we're talking about as we go along, because it's really important that we're speaking the same language. Super important. Now, this difference between net income and cash flow doesn't bother me as much because they're spending a lot on capital expenditures. That's what hurts free cash flow, but it doesn't hurt net income for many, many years. This is right in line with what Zuckerberg told Trump of how much money they're spending on capital expenditures. So this makes sense. There's a story that aligns with this. And I want people to remember that. They have a dividend. Why? 0.3% and eats up $5 billion of their free cash flow. I don't even get why. But guys, look at this. This is what I love. In the last 5 years, their average profit margin was 32.5%. Last year, it was 40%. Their profit margin is increasing. Why? Because their gross margin is 82%. Every extra dollar they bring in, 82 cents of it goes to the bottom line before taxes and overhead. That's how it can keep driving up this profit margin. If this stays at 82%, and as they grow their revenue, this profit margin is going to go from 40 and keep on climbing higher and higher. How much higher? I don't know. But if your gross margin is that high, you're going to keep, as you grow, you're going to keep increasing that profit margin over and over again. That's a huge, huge deal for the company. Finally, look at the returns on capital. 15.5% in the last 5 years, 17% last year. This means the company's getting better at handling and investing the money that's in their business and getting better returns as time goes on. This is the sign of a very strong company that deserves a premium. Very important to understand there. Let's go take a look at the 8 pillars and see what story it's telling us. Well, guys, 8 pillars. High returns on capital, buying back shares, which could be a good thing or a bad thing depending on when they were buying back shares. Cash flow growth of $31 billion in the last 5 years, revenue growth of $100 billion, net income growth of $48 billion. Oh my God, very little debt. But we have 2 red X's. What are they? Valuation. Now, for those of you who are new, just because there's an X here doesn't mean it's bad. And let me give you an example. Let's say a company was going to double its profit every year for the next 20 years. Would you pay 49 times free cash flow to get that? Absolutely, without a doubt. If it was going to grow its profit 2% a year for the next 20 years, that's insanely expensive. The 8 pillars are not here to say buy or sell. It's to tell a story. And Meta has a great story of growth, of numbers. Everything about it is a great story. The question is, what's the right price? Let's see what analysts think their earnings per share are going to grow by. Because remember, it's a great business, high returns on capital, but if it can't grow its profit as much as people want it to, then it's probably pretty expensive. And I'm actually surprised by this growth level in earnings per share, growing from $29 a share to $45. Looks like a big jump, and it is. 25, 6, 14, 12, and 18% earnings per share growth. That's a lot for a big company. But is it enough to justify 48 times free cash flow? That's the question. Look at the revenue growth. I'm actually surprised by these earnings per share growth numbers not being higher when revenue growth is pretty much the same level. Remember we talked about earlier, they have really high gross margin of 82%. So as they grow their revenue, a big chunk of that should go to the bottom line. So why is their earnings per share only growing by the same number as their revenue? Well, they could be hiring a lot more people to do this. Is managing these data centers very expensive? I don't know. These are the things to understand. Now, guys, we have numbers. We have a story. What do we need now? We need to put it all together in our stock analyzer tool to determine the right price to pay. This is what's so freaking important. We have to determine what is the right price to pay for this company. The story is going to allow us to put our numbers in and then spit out a price that makes sense. Let's go see what I did in the past for Meta. Okay, so I'm doing a 10-year analysis, and you can do 1 to 20 years here. I did 7, 10, and 13% revenue growth. Might be low. I can understand somebody saying, Paul, come on, that's insanely low. All right, I'm going to alter this. I'm going to go 8, 12, and 16%. Profit margin. Well, guys, they just did 40% last year. I had 27, 31, and 34. What the heck? I should go higher than that. Let's go higher. Let's go 32, 36, and 40. And guys, that still might be low. Why? Because if that gross margin keeps driving up that profit, this could be a low number. Now, this is the hard one. What PE would you assign and price of free cash would you assign to Meta in 10 years? Well, we know it's a great business, great balance sheet, has staying power, is a moat. But the average for the market is 15 or 16. My recommendation is you go up from here for Meta. How far up? I don't know. This is what makes investing an art and not a science. Let's call it 20, 23, and 26. I think that seems reasonable. The current PE is 26. I don't believe that you should try to match the current PE, but it doesn't seem unreasonable for the last 1 year's earnings. And finally, my desired annual return of 9%. 9% return. This is to match the market. This is not a return to say, go buy it for this. Because guys, if you can get 9 or 10%, just go buy a low-cost ETF and don't worry about the hassle of owning Meta. This is what's important. You have to have a margin of safety because the future's unknown, and we are humans and we make mistakes. So my recommendation is this number be a lot higher, but for the purpose of finding intrinsic value, I put in 9%. I hit the analyze button. The stock is currently at 730. Guys, look at this. A low price of 600, high price of 1700, a middle price of 1000. Based on my assumptions above, it's a 13% return based on discounted cash flows on my middle assumptions. That's pretty freaking impressive. Especially considering I was the guy who bought it all the way down to $88 a share, literally got it there and then sold around 200 like an idiot because I thought it ran up too far, too fast. Don't do that in the future. Learn from my mistakes. Our third stock is no stranger to wild swings when they report earnings. It's Tesla. Tesla is the company that keeps getting all the headlines, all the excitement, all the hype. Now look, Tesla is one of the most innovative companies in the world. There is no doubt about that. Elon Musk is an absolute genius. I don't care what you think about him. If you say he's not smart, you are a moron. He has built a brand that people believe in, sometimes a little too much. But as investors, our job isn't to fall in love with the story. Our job is to ask, what's real? What is already priced in? And what still needs to happen? In 2025, Tesla's actual results have been awful. In the second quarter alone, revenue fell 12% year over year. Automotive sales dropped 16%. Deliveries were down 13%, and earnings per share came in lower than expected, down 23% from the year before. And guys, that isn't just a one-time thing. Tesla's missed revenue and earnings expectations in 6 of the last 8 quarters. That's a pattern. But here's where it gets tricky. The growth story is still alive, and it's a big one. People are betting on Tesla not just being a car company, but as a leader in autonomy, AI, and energy. The big dream is a robo-taxi network. Fully autonomous vehicles that generate recurring revenue like Uber, but without the drivers, like Waymo. They're also working on something called Optimist, which is a humanoid robot that they say can handle physical labor tasks in the future. If that happens, it's massive. There's no question about that. And then there's the energy business, solar, storage, grid support. That's a real part of Tesla right now, and it's growing massively. It's more stable, It's more profitable. Gee, can you imagine something more profitable in a car business? And something that the market often forgets about. So there is real long-term potential. What's the problem though? Execution risk. Guys, it's not just about having big ideas. It's about delivering them on time at scale and with profitability. And that's where Tesla has always struggled. Go look at the history of Elon promising self-driving and every other promise he's made, Cybertruck, humanoids, it's always missed. Couple that right now with lower vehicle prices, falling margins, and missed deliveries. Guys, this is not good for the company. These are signs that execution is getting harder as the company scales. Some analysts are still very bullish. They believe in Elon, and I don't blame them. He is an absolute genius. They believe that he and Tesla will figure it out. Others are a bit more cautious, pointing to the recent earnings misses and a slowing auto business. So what do we do with all that? We come back to this core truth. Price is what you pay, value is what you get. Right now, a lot of Tesla's price is based on what might happen. The robo-taxi, the robot, energy revolution. If they pull it off, the upside is real. But what happens if they don't? You're paying today for a future that maybe never shows up. Now remember, guys, this company is still a car business today. Over 90% of its revenue comes from cars. Does it have potential to become something more? Absolutely. But as of right now, it's a car business. You know how I know that? Look at these margins. Gross margin is 17.5%. Car businesses are making 10 to 20% gross margin. That's a car business right there. Software businesses, Waymo, Google, Uber, their gross margins are multitudes higher than this. They can still build that out, but don't give them the value of all their revenue being this potential software and humanoid robot business when all their revenue numbers right now are the car business. You've got to piece it together. This company has a $1.5 trillion market cap and is selling for 17 times sales. The average car business sells for 0.5 to 1 time sales. This is selling for between 17 and 30 times higher than the average car business. Yes, this has more potential than the average car business. I get that. But you got to put these pieces together. The car business here, humanoid robot here, full self-driving here, put it all together. And I want to remind everybody that years ago, Tesla was a software business because of self-driving. Now that they realize it didn't work, it's, oh my God, Paul, no one cares about self-driving anymore. It's all about the robot. Okay, sounds good. Guess what? Self-driving software was going to be a big moneymaker until it wasn't. That's why I'm telling you to be cautious. Tesla worries me because I feel like people are paying a huge price. And guess what? In our community, people agree. Between strong sell and sell, it's 68% of the people who voted. That's a big number, guys. That doesn't mean the average intrinsic value is 160. So let's go see what analysts think about the growth of this business. Here's what's impressive. $1.70 per share in profit this year, growing to $9.65 in the next 4 years. That's huge. But let me remind everybody, if you put a 20 times multiple on this number, that means the stock's worth about $193. What's it currently selling for? That's 4 years from now. It's currently selling for $443. At the end of the day, this is huge growth. 35, 94, 60% growth in its profit. And still applying even a 30 multiple to this only makes it a $300 stock. Let's go look at the revenue growth. 17, 18, 27, 27%. So analysts are saying, yeah, the short term is going to be rough, but they're going to come through in the end and make it much bigger. Now, it's very difficult to do this for Tesla, but we need to do it. What's the price to pay? Because we have a lot of pieces we don't know are going to happen, and we're not assigning the probabilities to them. So let's see what I did in the past for Tesla, because I put in some aggressive assumptions. Okay, I did 6, 12, and 18% revenue growth. Okay, fine. Profit margin. Look at this. The highest they have is 11%, and the lowest they have is 6.5%. I did 15, 22, and 29%. I'm assuming they're crushing on everything everybody says, that they're going to become the next amazing thing with high margins and make a ton of money. They're going to become more than a car business. I'm assuming that right here. So then, what's my PE? I put 15, 20, and 25. I know, people want higher, so I'm just going to give everybody higher. I'm going to do 18, 23, and 28, and my 9% return. The stock's currently at 443. Guys, I have a low price of 85, high price of 577, a middle price of 234. Even based on my middle aggressive assumptions, it's looking like a 1.5% discounted cash flow return over the next 10 years if my middle assumptions actually come out to be true. That's something you have to consider going forward. The stock feels a little expensive. Doesn't mean it won't kill it, but it does feel expensive. Stock number 4, Google. Guys, our fourth stock owns this very platform that you're watching the video on, Alphabet. It's the parent company of Google, YouTube, and a ton of other companies. The top 2 search engines in the world, Google, YouTube. Now, people know Google for search. They know YouTube for videos. But what they don't always realize is how strong this company really is under the hood and how much it's investing into their future. Let's talk about what's driving future growth. Ready for it? It's a term you've never heard before. Artificial intelligence. Google is going all in, spending $85 billion to build AI infrastructure and train the right people. They're not just playing catch up, guys. They're building the tools that will power search, ads, cloud services, and maybe even things we haven't even thought of yet. It's Google Cloud. That's their service for companies that need secure data and computing power. Cloud revenue grew over 35% last year. That's a serious engine for growth. Now, obviously, a lot of other companies are doing the same, but it's a very high margin business. And of course, there's YouTube and Google Search. These two alone bring in massive cash flow, which helps fund everything else. So even if one part of the business slows, the others help carry the load. They've got big bets for the future like Waymo, their self-driving car project, which I personally used for the first time 2 weeks ago. It isn't profitable now, but long-term, it could be a game changer. And I'm going to tell you, I loved it. Now, I will say, the car was a little dirty, smelled like weed, but it was nice that nobody was driving the car. I just got in the car, it took me from the parking garage to the airport, and just seamlessly, it was wonderful. Now, like everything, guys, there are some risks. First off, they're spending a lot of money. And if those AI and cloud investments don't pay off, that is going to hit the profits very hard. Second, regulators hate people who dominate, so they're watching. Google has been in and out of court over antitrust issues for many years. It hasn't broken the business yet, but it definitely adds uncertainty. And third, companies like Microsoft and Meta are pushing into AI too. The market is moving fast. Google has the lead today, but they have to keep earning it, especially in an environment where things are changing very quickly. You've got to remember, this is still a long-term investment. We don't try to guess the future. We buy businesses we understand at a price that makes sense with ample margin of safety. So let's go take a look at Alphabet, Google, $3 trillion business, essentially the same enterprise value, which means practically no debt on the books. No debt, guys. Guess how much I love that? It's the best. Now, look at this. $115 billion in net income last year, $67 billion in free cash flow. That just shows, since free cash flow is cash from operations, cash from the business, minus the capital expenditures, the data centers, all these things they're building for the future. That's why the free cash flow is so much lower than net income, because you can see that the 5-year average net income is much closer to their free cash flow in the last 5 years, 80 billion versus 64. So clearly we're seeing a difference here that's probably easily explained, okay? There is a dividend. 0.3% pays $10 billion. Why? I love these companies with their adorable dividends. But here's what's great. Look at this profit margin. 26% a year for the last 5 years, 31% last year. So is this an upward trajectory of their profit margin? Could be. That's a big, big benefit for them. Think about it. All they're trying to do is expand their computing power. Because if 1 million more people used Google every day or YouTube every day, how much would their costs really increase? Probably not a ton. It'd probably a lot go to the bottom line. That's the big benefit of companies that are selling basically bits on a computer. That's what's so great. And of course, we have increasing returns on capital, which is great for showing what a great business this is, and great growth rate on revenue. 3-year compounded growth rate of 10%. But I want you guys to notice something when we do Stock Analyzer. 10-year revenue growth, 18, 5-year, 17.5, 3-year, 10%. As you get bigger, it's harder to grow that revenue. Doesn't mean they can't. Let's say Waymo becomes the next Uber and actually replaces Uber tomorrow. That'd be a huge revenue generator for them. That would skyrocket their revenue growth. Those are the things I want you to consider, and you should consider when valuing a business. Now, let's look at the 8 pillars here. Very similar to other tech companies. A lot of check marks, low debt, buying back shares, cash flow growth, revenue growth, net income growth, high returns on capital. It's just these 2 valuation metrics. But again, we're not going to prejudge with these high growth businesses and these top quality businesses. You've got to pay a premium for them. So let's see what analysts think. So analysts see $10.23 per share this year in earnings, growing to $17.80 in the next 4 years. That's 24, 7, 13, 17, and 23% respectively. And the revenue growth side, 12, 11, 10, 11, 10. So remember these as we do our analysis into the stock analyzer tool, which is how we put the story and the numbers together. So let me pull up the last time I did Google and see if I need to alter anything. All right, so I did 5, 9, and 13% revenue growth. I could argue that if analysts are expecting 10, I might want to be more conservative, but we'll keep it there for now. Here's something though, profit margin. I do think I have to question, is this a permanent level? I have to wonder that. It's not an unreasonable discussion to have here. And by the way, I'm probably going to ignore free cash flow because they're big investments lately. If they pay off, if they don't pay off, they'll still be showing in profit margin later on down the road. But I'm looking at this saying, should I make this higher? I can understand the argument both ways. Well, Paul, they only have 1 year of it. Yeah, I get that, but it's Google, and every year that goes, they become more entrenched in our lives. Is this profit margin also more entrenched? So I think I'm going to increase it slightly. I think I'm going to go 26, 29, 32. And guys, if you have our software and you don't agree with me, that's what makes it great. And for the other thing, guys, we're probably going to be deleting the previous PE and price of free cash flow because I want you to realize that you should start at around 15 or 16 and go higher for great businesses with great growth and lower for bad businesses with bad growth. So here, I'm going 20, 23, and 26. And guess what? If you think that's too low, I don't blame you. If you think that's too high, I actually would argue that it's probably more likely to be lower than higher. I don't think this is too high for a company that's so entrenched in our lives. This is, and with such a great business and a great balance sheet. I think it's a reasonable valuation. And finally, our 9% intrinsic value return. Hit the analyze button. The stock's currently at 256. Wowza. 170 on the low side, 470 on the high side, 280 in the middle. Guys, I want you to keep in mind, just a year and a half, 2 years ago, I was apprehensive about buying Google at 100. And guys, 25, 30 years ago, I would have just bought up the story. I wouldn't even done this analysis. That was the whole point of this software. That's the whole point of this channel. I teach on YouTube because I remember seeing all the mistakes I made 25, 30 years ago, and I thought, with the internet, I can help people avoid those same mistakes I made. With these tools, I can give people today the tools that I had to spend and develop. I had to spend hundreds and hundreds of thousands of dollars, if not millions, to develop to get it in the place I want it to be. These are the tools that I made for myself that I just sat there and said, okay, everybody else can benefit from this. I used to be the exact same hypester that I criticize today 25, 30 years ago. I would have bought based on story, based on hype, based on tips. And then when things went poorly, I was left wondering why. Now, the benefit I had was I didn't run away from it. I said, okay, there's something to be learned here. And things started to make more sense when I realized that when I bought a stock, I was buying a piece of a business. But more importantly, as time went on, the numbers are important. But what's more important is having a process and surrounding myself by people who I'm able to learn from, like-minded people who think in a similar way, but may not always agree. What I mean by that is I look at value investors all the time. And we all speak the same language, but we don't necessarily agree on certain stocks. I see things that Warren Buffett even owns, and I'm like, I wonder why he owns that. Like, I don't get it. And there's other things that people, I'm sure, look at me that I own, they go, why would he own that? I don't get it. This is the whole point of investing. It's about like-minded thinking, surrounding yourself by the people, but also having the tools to be a better investor. So if you're really serious about being a better investor and upping your investment game, leveling it all up, this is the place for you. Check it out. Our community, click the link below. You get the community, you get the tools, you get everything there that we've looked at and more. All try it for a 1-week trial. If you sign up, there's a reason why 83% of the people who sign up for the 1-week trial end up signing up for the year. There's a reason for that. It's because they fall in love with it and they see how awesome it is. Now, stock number 5 is a very interesting one, Carvana. This company went from collapse to comeback. This stock has been an absolute roller coaster, and I do not say that lightly. Back in 2022, Carvana was this close to falling apart, this close to bankruptcy. The company lost over $2 billion in 1 year. People were calling it dead, and rightly so. The numbers were not good. It's not like the other companies we talk about where the numbers are getting better and people just see the stock price and say, oh, it's dead. The numbers were bad. Bankruptcy was on the table. Fast forward to 2025, though, it is now posting record revenue. That kind of turnaround is rare, but it's worth paying attention to, and here's what happened. In 2022, they were losing money fast, huge expenses, no real path to profitability. It looked and felt bad. But in 2023, they started fixing things. They cut costs. They improved operations. And by 2024, they were back to growth, bringing in over $13 billion in revenue. Q2 of this year, Q2 of 2025 was their best quarter ever. $4.8 billion in revenue, selling over 143,000 cars, and most importantly, posted $308 million in profit. So what changed? Carvana figured out how to run leaner. They bought Odessa, a big car reconditioning company, which helped them clean up and deliver used cars faster and cheaper. That made the experience better for customers and boosted margins. Their online platform also started working the way it was supposed to, more efficient, smoother, scalable. Now analysts believe this company could sell 3 million cars in a year in the next 5 to 10 years. Some even think they could profit over $3.5 billion a year by 2028 with a stock price over 500. So yeah, the growth potential is real. But let's not ignore the other side. Carvana is still in a high-risk business. Used car sales are cyclical. That means they go up and down with the economy. Interest rates, inflation, job markets, all of that matters. And even though they're making great money now, their stock is already priced, from what I see, like the future is guaranteed. That's dangerous. If they even miss one step, that stock could drop fast. So what's the lesson here? Turnarounds can happen, but they come with risk. Carvana has pulled off something impressive, but the price already reflects a lot of that success. So if you're going to invest here, you've got to understand what you're buying. And more importantly, what can go wrong. Because we don't buy based on past excitement. We buy based on future value. So guys, like I was saying, look at this chart of Carvana. It literally got down. It was as high as 376. Is that the highest I'm seeing? 376. And as low as, I remember $3 a share at one point. I don't know when exactly that was hit. 376 right here in December of 22. So guys, even if you bought back here, you're not even break even yet. It's at 337. That's incredible. All-time high is $413 per share, though. This is an incredible ride for a company. $48 billion market cap. That means when it was at $3 a share, it was basically $480 million market cap. Now, free cash flow, $600 million. 5-year average was negative $700 million. That shows you the difference there. Now, the PE, though, 86, price to free cash flow, 78. But they could make a lot more money going forward. And guys, I like this. Gross margin of 22%. Way better than the new car manufacturers. And this profit margin is getting better and better and better. So let's see what analysts are thinking about this company going forward. Well, let's see what the pillars are first. Ooh, I thought it was going to be bad. Look at that. But they bought back shares. The question is at what price? That's important to understand. Let's see when they were buying back shares. Let's go to the income statement. Now, guys, I want to show you guys something. This is where it's important to understand things. At the bottom of the income statement has our shares outstanding. Diluted shares outstanding jumped up in 23. Now, I want to go verify that, but I look at this saying at that price, at that point, the stock was down so much, maybe those diluted shares included options that were never going to get exercised because of how bad they were. So in actuality, the shares are actually up. 82, 100, skip this, 132, 140. So Carvana keeps diluting its shareholders. That's something to be very apprehensive about. If you're new to investing, that is not good for a company, for their investors. Well, I shouldn't say it's not good. At these high prices, go for it. Get cash in the coffers, but you got to remember as an investor now, every time they issue more shares, You still own the same number of shares you have, but you're now splitting the revenue and profit amongst more partners against your choosing. So as an example, if there's 10 shares outstanding, you own one, you own 10% of the business. If they add 2 more shareholders, you're now one of 12 shares. You're 8.33% of the business, not 10 anymore. You did nothing but stay patient and you got diluted. Let's go to the analyst estimates. Analysts have this company doubling its profit in the next 4 years. 490 to 1081. More than double. And its revenue growing from 19 billion to 46.5 billion. Huge growth, guys. But it's the car business. It's a tough business. I'll tell you what, though. I like Carvana's business model. I really do. But let's go figure out what's the right price for Carvana. I don't know if I've ever done Carvana, have I? I have, a long time ago. Look at this. All right, here are my assumptions. One thing I want to point out, look at the swing from negative ROIC to positive. Now, revenue growth. I did 3, 5, and 7. We got to change that. Let's go with 5, 8, and 11. Profit margin. I'll go 2, 3.25, and 4.5. This just seems like a reasonable assumption for the future. Could get better from there. PE, 15, 17, 19. I think I'm going to do 13, 18, and 23. Big swings here. But the reason being is if they don't do well, it's going to be a dud. If they do very well, it's probably going to be a premium business. But more likely, it's probably going to be somewhere in the middle. And then my desired return of 9% across the board. I hit the analyze button. The stock is currently at $337 per share. A little apprehensive here, guys. 32, low side, 150, high side, 78 in the middle. It's pretty far off, but this is just math working here. Now, guys, something more exciting is early this year, I picked my own Magnificent 7, my own 7 stocks that I own to go head-to-head with the real Magnificent 7. So click the video on your screen to see which 7 stocks that I own and picked and how they stack up. I guarantee you the results will surprise you like they did me. Thank you for your time.